Now that we studied perfect competition, we want to start to look at some other forms of ways markets can be organized. And our next step is going to be to study monopolies. A monopoly exists when there's a single firm or a single seller in the market, and there's barriers to entry that prevent other firms from coming into the market and competing, either by making the same product or a very close substitute. I wanted to bring this graph up now, early in the course, where we can look at market structures organized according to how many firms are in the market, indexed by N, so that's the horizontal axis, and then how competitive the market is, measured by the vertical axis. A monopoly has one firm and very little competition, whereas perfect competition has a lot of vigorous competition and many firms. So in a lot of ways, these two will be polar opposites. Later in the course, as you can see, there's lots of empty space in this graph. We'll be filling in the space in this graph with other forms of market organization. There's four main causes of monopolies. The first is sole ownership. If there's only one person who owns the resource that is being sold, then that person will have a monopoly in that market. For instance, there's only a small number of Kyber shards in the Star Wars universe, and these shards can be used to make really powerful lightsabers, heal people, and have other sorts of magical properties. So the one planet that owns these shards is the monopoly seller in that market. A second cause is patent protection. So in a lot of pharmaceutical markets, a company has a patent on their drug, and they're the only company allowed to make that drug for about 20 years. A good example is Avastin, which is a cancer treatment drug. It can treat a lot of different types of cancer, and only the one firm that owns the patent is allowed to make it. A third form of monopoly power is government franchising. So for instance, the U.S. Postal Service is the only company that's allowed to deliver mail to your house. We could imagine a world where other companies like UPS or FedEx delivered mail, and they might compete with USPS like they do for delivering packages, but by law only USPS is allowed to compete in that market. The fourth case is a natural monopoly. This is where there's so much increasing return to scale that it really only makes sense. It's only efficient to have one firm that really takes advantage of those increasing returns to scale. It's hard to think of examples of this in real life. In fact, it's actually controversial how common natural monopolies are. So I'll leave it to you to read the helpful hint that goes over the example of a natural monopoly. But I'd like to remind you that you only need increasing returns to scale in this natural monopoly case. The other three types of monopolies, the more common monopolies, don't necessarily have increasing returns to scale. So when we're trying to figure out how much output and as a result what price will prevail in the market that the monopoly picks, we have to decide on a goal for the monopoly. And we'll use the same goal for the firm that we had in the perfect competition case. They're going to try to maximize profit, which is revenue PQ minus costs, C. As a result, they'll use the same rule that the competitive firms used. They'll equate marginal revenue with marginal cost so that they can maximize their profit. The difference between this case and the perfect competition case is that when we dealt with perfect competition, the demand curve was perfectly elastic and it made marginal revenue equal to the price. So marginal revenue was really easy to find and work with. In the monopoly case, if they raise output by 1 unit, they'll have two effects. First, of course, they'll be able to sell that 1 extra unit of output, and that will help raise their revenue. But they'll also have to lower the price to get the market to clear. They won't be able to sell all of their units at the old price if they were charging the maximum that the demand would allow. So they're going to have to lower the price if they want to sell more units. So as a result, our function for revenue is PQ, and we can see that regardless of whether we increase output by 1 unit or decrease output by 1 unit, the two variables are going to move in opposite directions. We can have Q go up and P go down, or P go up and Q go down, but we can't have it both ways. As a result, our marginal revenue has two terms in the analytic representation. The first term that we discussed above is Q goes up, and we sell that unit of Q for approximately P dollars. And this is the old term we had when we looked at marginal revenue for the perfect competition case. Our delta Q was 1, and our marginal revenue was just P. This one's going to be positive when we're raising output. But there's a new term as well. Since we sell all the units that we were going to sell, the Q units we were going to sell for P dollars, now we have to sell at a lower price. So if the price went down by $2, all of our units that we sold would get $2 less revenue, would generate $2 less revenue. So this is our new term, and it's negative. Graphically, what this adds up to is that when we sell more units, we don't just get the revenue that the demand curve indicates. The demand curve says we could sell, suppose this was 5, 3, and 1. If we could sell according to the prices that people are willing to buy on the demand curve, we could sell the first unit for $5, the second unit for $3, and the third unit for $1. But since we have to set one price, our marginal revenue is going to be less than the revenue we get just from selling that extra unit. We can't just get the $3 from selling the second unit. We also have to lower the price of the first unit, and then we lose $2. So as a result, graphically, our marginal revenue curve that we'll draw in is going to be below the demand curve. And this will be true as long as the demand curve slopes down, which for our purposes is in every market. So to review, I want you to fill in this diagram, which looks a lot like our diagram for perfect competition. Use it to find the equilibrium, the quantity that the monopoly chooses that equates marginal cost to marginal revenue. Then use it to find the price they charge in the market. The price they charge will be the maximum that the demand will allow. So you can go vertically up from the intersection that the Q you pick all the way up to the demand curve, and then left to the price, and then that will determine the price. It'll be the vertical distance from 0. And then you can find profit just like you found in a perfect competition case by looking at the difference between average total cost and price, and then multiplying that by the quantity sold.